What's up, everyone? It's Cody with Money Investing. If you guys can hear me, just see me, just give me a thumbs up in the live chat and we should be all set. Welcome on board, everybody. Market's obviously selling off quite a bit, being dragged down by a lot of names. Of course, leading the way is Meta, down a little bit over 24%. Then we got Amazon down 4% ahead of earnings, and Apple also selling off a little bit over 2.7, almost 3% prior to the earnings coming out in about 22 minutes here. Google and Microsoft down about 1.6, 2.2%. AMD's in the red. Nvidia is pushing higher up over 2.8%, and Netflix also pushing up over 76 basis points. So welcome. We're going to do a little bit of a market close live stream today. Was not able to do market open, but we're definitely going to do a closing live stream, and then we'll take a look at the live reaction from Apple and Amazon's earnings, and we'll see what those numbers kind of look like. And then we'll also take a look at the earnings call for when these companies start their presentation and their webcast. We're going to listen in on that as well. So hope you guys are doing great. Welcome on board, and make sure that you drop a like and subscribe to the channel if you're not already. And we're ready to go. We'll see how markets react to Apple and Amazon's earnings here. We do have the Nasdaq down over 1.3%. We've got the S&P selling off over 34 basis points, and we've got the Dow Jones slightly higher, 279 points in the green, up over 88 basis points. The 10-year yields are now back under 4%, so that's a really good thing. So we're down a little bit over 1.39% for the 10-year yield, so they're back under 4% at the moment. Crude oil is back over $88 a barrel, so it has been pushing higher, so that's really not good, because in the month of October, it's up a little bit over 8 to 9%. We did have GDP come in today, so I'm going to take a look at that very quickly. So GDP came in at 2.3%, actually 2.6% growth for the third quarter. This is the first estimate though. So third quarter GDP is expected to accelerate 2.3%, annualized growth versus second quarter contraction of 0.6%. So 2.6% was the actual number. That's the first estimate. We still have the second and of course the final estimate still yet to come. But this is surprisingly higher. This is incredibly high for the third quarter, considering that rates were much higher and the dollar strength was still strong. But I'm sure this over the coming weeks, over the coming months, this will potentially get revised down as we get that second and final estimate. So Kevin asking, what are your thoughts on Apple earnings? Are they going to miss? It's a tough question, man. It's a tough question. You never know in this market. You know, I've got Apple on the left here, Amazon on the right. Yesterday, I was not expecting Meta to beat on revenue, but they did. But of course, missed on earnings. I didn't expect Google to miss on either of those, but they actually ended up missing on both revenue and EPS. And then on Microsoft, they beat on both revenue and EPS, but they were still down over 8%, 9% after hours, right? So it's a really significant sort of like really mix market sentiment here, given what we're seeing for a lot of companies. And Meta volume 211 million shares. Let's take a look. So yeah, 212 million shares. That's insane, right? So many shares being traded for Meta today. That's like 4 times the average 10-day volume. So pretty substantial amount of volume coming in. So Giancarlo, I will be posting a Meta dedicated video in our Patreon. So for our members only, I will be posting that. I mentioned in our Discord earlier today that I will be posting a more dedicated video on Meta over the next few days for our members. So that's going to be available very soon. But yeah, there's just a lot of research that I've been putting in, so I'm going to be going over a lot of different things for the company. A lot of the damage is pretty much self-inflicted, right? It all comes down to the metaverse, right? And there was something that Mark Mahaney mentioned after the fact that they already announced their earnings call, was every time there was a mention of the spend, the capex, and of course how much they're going to be spending on the metaverse, the stock traded down, right? The stock traded down, made a new low. So really their core business was very good. If you take a look at their core business alone, DAUs, MAUs, revenue, those are all very good numbers, and the advertising spend is kind of stabilizing. It's not deteriorating as badly as what many expected, but it's really that capex, right? It's not matching the revenues right now, and the company's already spent close to over $20 billion this year in R&D, right? So that's really what investors don't like. It's the spend on research and development, and then as a result, the net income is hurting right now. The net income is literally deteriorated or pretty much come down on 4 consecutive quarters, right? So a lot of it is self-inflicted. It really comes down to what Mark Zuckerberg ends up doing, and obviously, their goal right now is to spend a lot on the metaverse. And if that doesn't stop, or that doesn't come down to match the revenue and the expenses, then unfortunately, this is the sentiment. Investors obviously have made themselves very clear by the stock coming down so much that they don't prefer the 10 billion. And Mark Maney mentioned in that interview as well that we prefer 5 billion or something which is more in line with the revenue or the expenses. But right now they're definitely doing that at a time where things are already really, really tough. Things are challenging from an advertising standpoint, and as a result, the stock price obviously has been absolutely destroyed, right? The sentiment's at rock bottom. Like, the sentiment around this company is literally at rock bottom right now. Just horrible sentiment. Anyway, so yeah, Meta said CapEx would go up next year, and that's exactly my point, right? I mean, investors don't want to hear that. They when most companies are doing these cost cutting, and they're pretty much trading on a budget, and they're pulling back on some of the expenses. Meta's like, nope, we're gonna ramp up and we're gonna spend even more on the metaverse. So really what it comes down to is how much does this company end up spending? Because the balance sheet's still good. It's a very, very dynamic sort of situation where you've got a good balance sheet now, you've got a great balance sheet, and you've got the core business which is stabilizing. It's not deteriorating. It's actually good. It's in good position. How much do you want to spend on this project, right? And when and if are we going to see that revenue, that profitability generate from this business? And the timing of this needs to be at a point where that business needs to start showing profitability and start showing some good revenues and some good numbers before they actually start running out of cash, because then that's the critical timing dynamic that we're dealing with. So every company is spending money on this, like every company. And again, I was listening in on a couple other interviews and a couple other research articles. Google is spending money on the metaverse. Apple is spending money on the metaverse. Every single company is doing something on this mixed reality, augmented reality, virtual reality, but it's not taking up a big expense from their balance sheet, right? For Meta's case, it's actually a lot, right? They're building everything around it. So, can we make a case that they're the leader in this sort of market? Sure, they are. They're leading the pack in terms of how much they're spending on R&D, but is that going to pay off, right? Is the ROI really there? That's the question that we still don't know the answer to. So anyway, let's take a look here. What's your Meta fair value now, Brandon? I will be doing an update here for members. Like I said, I will be doing a private dedicated video on Meta here very soon, and that will be released shortly. Let's see. Please, Amazon, Apple, don't send S&P down to hell. So yeah, Apple is already down a little bit close to 3%. Amazon's down 4%, and we'll see. We'll see what happens after hours. It's gonna be interesting. I mean, we have seen, well, pretty much all stocks have sold off after hours, right? We've got Google, Microsoft, and Meta. So all three have pretty much sold off after hours. Even Tesla dropped after hours on earnings. So we've pretty much got all FANG stocks and all big tech selling off after hours, and it all comes down to these two companies right here that I have on my screen, whether they're able to change that trend, or if they're going to continue to sell off even more and then continue on that trend. So Jolly Joker says Meta will be an example of how they'll teach universities how to not screw up your company. Well, I would say, well, it could be a case study to how, well, really comes down to timing, man. I mean, we could, there's obviously a lot of criticism. Hey, look at Tesla, right? 2 years ago, there's Tesla's going bankrupt, right? Tesla's going to be done. They're literally running out of cash, and they're not. You go back 2 years and you read the articles, you read the comments, and you do your diligence 2 years ago from Tesla. The sentiment was so bearish. Ask any Tesla investor from 2 years ago, 3 years ago, from 2018, 2019, right? Ask them. Ask what the environment was or what the sentiment was around Tesla. It's the same thing, right? Timing is such a critical thing here. Obviously, Meta not going through a great time right now, but who knows what happens 3 years from now, or 5 years from now, or 7 years from now, So it's a fair point, sure. It can be as case study, as a joke to how not to screw up your company. But look, 5 years from now, it could be a case study for how to invest in the future. You never know. So Moit says the metaverse is a good idea, but requires participation from the SMEs, open source community of developers to augment and drive user-based adoption, in my opinion. Yes, the options really Yeah, Kevin says I was in Tesla then, it was bad. Yeah, so ask Kevin how the sentiment was, right? When everybody, literally every piece of article, every sentiment, all comments board, everything like literally is battering down on that company or that stock. It's a tough environment, right? And Tesla has gone through that, and they proved everybody wrong by investing in the future of electric vehicles. And look, adoption took on, and literally that's where Tesla is now, over a $1 trillion market cap company. So that's why I think it's still too early to write a company off just because they're investing in the future, and you know they think that this is going to be a big thing. Yeah, so Howard says, have to believe in Meta. If the Meta flops, that a lot of R&D failed, like coin toss, keep it small percent invested. Yeah, so I that's true. I think really what it comes down to is, you know, and this is something that was also shared as an open letter to Mark Zuckerberg. I forgot what his name was. I was reading a report earlier. There was an open letter actually shared to Mark Zuckerberg. And in that open letter, they literally mentioned if Mark Zuckerberg had simply said that we're going to pull back on our investments in Metaverse and kind of bring down the CapEx, the stock would have been up 10%. Had he said that we're going to do a bigger cut to cost and CapEx, the stock would have been up 20%. So it's pretty streamlined. We all know what the market wants from Meta, and that is for them to pull back on their CapEx spend. That's it. I think the markets made themselves very, very clear. And I was listening to Josh Brown as well earlier. The markets made themselves very clear that we do not like your investments in the metaverse, period. That's what it is. So it really needs to come down to a small percentage of overall revenue. 10 billion, 15 billion, 20 billion is a lot to be spending on something that may or may not work out. Now, I personally do think that there's a lot of value there. This is going to be a big market. There's a pretty significant use case, but there needs to be a better ROI with the amount of money that they're spending. All right, anyway, so we got Apple and Amazon in 10 minutes. That's what we're going to focus on. Enough with the meta talk here. So let's take a look. Apple earnings at around 4 p.m. Amazon also coming in at 4 p.m. So Naman is asking, are Amazon and Apple overvalued according to you at the moment? So great question, interesting question. Really depend on what type of growth we're looking at, right? So Apple, in my view, still at over, I think 20 to 25 times earnings is certainly pretty substantial, right? If you ask me, like the growth rate is nowhere near close to those levels. So it is a little bit of a higher P multiple. And price to sales, I think it's come down, but I think it's still trading at over 6 or 7 times sales at the moment. So if you take a look at, it's trading at over 6 times sales, so which is reasonable. I mean, in the past, Apple has traded at around 5 and 6 times. We've gone over Apple's chart. Let me see if I can bring that up here very quickly before the earnings are released. And really what it comes down to is whether, so if you take a look at Apple's, this is the valuation, price to sales, price to free cash flow, and price to earnings. Historically, if you just simply draw like a line, an average line here, you'll notice that we have traded around these levels, right? So that's the price to earnings on average, which is around 16 to 17 times, might be a little bit lower. And of course, during COVID times, it actually got up to very, very high levels. We're talking like, 35, 40 times earnings, over 30 times cash flow. It has come down to more reasonable levels, and the price of sales, which is the blue line, has been around 5. So, looking at those metrics, it is a little bit higher, considering that growth is also slowing down. And then for Amazon as well, I can probably make the same case where, price to sales is really low. Price to earnings is not optimized perfectly right now because, again, they've not been too focused on earnings. So my fair value on Apple, of course, is 116. My fair value on Amazon is at low 100s. So, we'll see if you have actually come down to those levels. All right, let's take a look. Which EMA lines do you have on your 5-minute chart? So I basically use the 9 EMA, the 21 EMA, the 50 EMA. Those are some of the basic ones that I use on a regular basis. Yeah, so InMode I will do in a separate video. So I think InMode already reported earnings, didn't they? So let me see here. Yeah, so they already reported earnings. A little bit of a miss on earnings. Very strong growth on revenue. The stock price is up over 5%. I'll see if I can actually do a video on InMode here shortly after. So that will be covered in a separate video for sure. I'll see if I can do a video on them. So, all right, let's just quickly do an audio check. And we'll have both of these charts open right at the close. The expectations really here, let me just take a look if I have that spreadsheet still with me. Let's see. All right. So earnings really are about $1.26 for Apple, revenue of $88.7 billion. And then Amazon, we're looking at $127 billion, which is just insane how they keep growing that much. And 21 cents, under 22 cents is going to be that earnings per share estimate. So let me know if you guys can hear this audio. Just want to make sure that everything is working well. So
gaming side, you see this with Roblox, with Unity, with Epic Games and Niantic. And the other is what Microsoft and NVIDIA call digital twins, or the industrial metaverse. It's taking a look at a much, much larger TAM than consumer discretionary, digital, or certainly gaming, with much, much more staple customers and a much longer progressive ramp. Going from a new vertical in both virtual reality devices and enterprise productivity software, where you need to pioneer the tech, pioneer the understanding, pioneer the software, and then drive enterprise adaptation, that's the timing issue. Many believe in this opportunity, but they're giving it more time to unfold.
Do you do anything with Meta, with Zuckerberg on this front? Are you working with them at all? You don't?
No, never have.
Because I think the criticism, besides all the spending and what it's going to take, is just trying to envision just what that is. Is it commerce? Is it social? Is it all of the above? I know you've been on many times to remind us about that, but does Zuckerberg's vision line up with the analysis that you do?
It does broadly, but it correlates to what I just mentioned. When you take a look at the centerpiece of their strategy, it's very much focused on virtual reality headsets and the transformation of enterprise productivity through those devices. I tend to hold the opinion that these devices are farther off than many have expected before, and Meta seems to today. And that's going to be a challenge.
You're going to get your ticker symbol back, Meta, before they took it?
I'm just an index provider to Roundhill, which operates the ETF and security.
Right. But used to be Meta.
All right, good. Audio is working great. We are all set in about 5 minutes. We're going to find out, man, what Apple and Amazon have for us in store, because this has been a brutal freaking week for the markets. If you take a look at how the NASDAQ has done this week, it is down actually not that much. This week, the NASDAQ is not down all that much. It's down about 0.69%, so it hasn't been that bad. It was obviously much higher earlier in the week. Today is only Thursday, right? Yeah, so it was higher, earlier in the week, and of course today down about 1.7%. Yesterday down 2%. So really it was Tuesday and Monday that kind of held us up, and they were just coming back and rotating back down to those levels. So, all right, Apple 4:30, Amazon is at 4 p.m. sharp. So yeah, that should be interesting here very soon. S&P is for the week pretty much flat, I think. Actually up 1.37%. So pushing higher here at the moment. Intel, let's take a quick look on Intel as well. Let's see what Intel's doing. So down 3.75%. They're also reporting earnings right after the bell, 33 cents in EPS with $15.3 billion in revenue. Intel's kind of like very similar. They've got a little bit of a strategy shift, and obviously putting a lot of effort into their fab business, manufacturing, and all those things. So we'll see what type of capex that they're working with, because they've also got a pretty substantial capex similar to what Meta has. Caddy Shop up 17%, amazing. Yep, so Shopify pushing higher very nicely, up over 17%. I looked at that earlier, so very significant move to the upside for Shopify, and getting a big breakout above $30, right? So it was kind of tapping on that level quite some time. It was kind of like getting rejected, and then we got this big breakout with a lot of volume, and of course after the earnings as well, beat on EPS, beat on revenue, so we got a double beat. And up over 17%. So next resistance and target's really going to be all the way up to $40. So that is going to be that next level to watch, all the way up to $48, $49 for Shopify. I don't have a fair value in Shopify yet. I'm going to have to take a look at the earnings, but looks like they again didn't report profitable earnings. In other words, it was negative EPS. So we're going to have to wait until they turn the corner towards profitability. So, all right, expectations here, quick expectations for Apple and Amazon. Just tell me Apple beat, miss, Amazon beat, miss on both revenue, EPS. What are the expectations here? You know, Shopify beat on revenue. So that's a pretty good ink link between e-commerce here. So, you know, Amazon $127 billion revenue number is a possibility. And then, of course, with Rivian's, you know, gains, it is possible that earnings also end up beating. But of course, the guidance is what's going to be really important, because if ad spend is coming down, marketing budgets are coming down, you know, it's the guidance is going to be a little bit wavery here. But they also have, or they had a couple of their Prime Day events. I'm pretty sure they have another one coming up in the fall, maybe later this year. So that might be a little bit of a boost to overall revenues. But yeah, Rivian has screwed us in the last two earnings. Absolutely. So let's take a look. Let's see. Amazon miss, easy beat, both miss, miss, Apple miss, and miss. God, there's so much pessimism. I love it. Apple beat. Okay, a couple beats here. Gabriel says Apple miss. Apple always undersells and over delivers. Amazon hit. Apple beat. Amazon miss. Amazon beat. Milan says market crash, the world is ending. Man, it's been crazy. Yash says I have 1,000 Apple stock, getting anxiety. Oof, it's a lot of shares there. Frank says I hope Apple drops, their products are so lame, the same stuff for years without jobs, they're lost. Interesting. Amazon beat. All right, so here we go. Amazon first, and then it's Apple. So we're gonna keep a close eye on Apple, Amazon here. I'm gonna play the CNBC going on over here.
On that list, we're also seeing highs in Campbell's Soup and Smucker, talking at least 52-week highs there. And the lows, of course, are in technology. Alphabet trading at a 52-week low. Meta, no surprise, Align Technology as well. There's the Dow, 181 points higher. So that'll be the fifth day in a row of gains. It comes on the back of non-tech earnings being strong. Seema told you about Caterpillar. McDonald's also adding 56 points to the Dow. Honeywell, Boeing, Goldman Sachs, they're all higher today. It is technology, though, that is suffering. The NASDAQ closing out with a loss of 1.6%. A lot of that, though, is Meta and the fallout effect. Amazon and Apple coming next. That's it for me on Closing Bell. See you tomorrow, everyone. Now into overtime with Scott.
All right, Sarah, thank you very much, and welcome everybody to Overtime. I'm Scott Watney. You just heard the bells. We are just getting started here at Post 9 for the New York Stock.
Ooh, that's a big drop. The same thing happened with Meta last night too. It actually went up though, and then it started selling off. So we'll see here what happens with Amazon.
All set to report earnings with so much on the line. Can they reverse the mega cap meltdown started by Microsoft and Alphabet, only to be made worse by Meta? Have the chewed up chips bottomed? We'll get to the answers, all of those questions, in just a matter of minutes. Our team of experts standing by with everything you need to know as well. Let's welcome in CNBC contributor Stephanie Link of Hightower.
That's a big drop. 10% on Amazon already. Ugh.
That we've gotten already.
Yeah, and so far it's really been disappointing. I mean, last night obviously an epic disaster in Meta, and right now a lot of white knuckles going into the Apple and Amazon. Can they save earnings season for tech in terms of big cap tech, or ultimately does the softness continue? And that's why I view it as really a bifurcation that we're seeing in tech on enterprise and consumer. I still believe Apple is ultimately going to surprise, be much better than expectations.
Yep. All right. So Amazon is out, and we will certainly keep our eyes peeled there. You can see the stock is moving, and it looks to be just down a bit here, about 10%. We are going through that as you would expect. Deirdre Bosa is. She's going to pop on momentarily. Stephanie Link, a stock that you used to own, you do not anymore, and the stakes could not be higher for now. It's down about 11%. So we need to dig into that. Does it return to profitability? Right? Had that first loss in some 7 years in the first quarter, backed up with another loss in the second.
So it trades at 80 times forward estimates. So this is not the kind of market that you want to be owning something that's 80 times for the uncertainty that you're talking about. AWS, I'm really interested to see where the cloud numbers come in, because we know that Microsoft guided lower for their cloud business. And we also know that Alphabet was a little bit behind in terms of their cloud business. So want to hear about a little bit about that, but also e-commerce. I mean, you are seeing an economy going from goods to services, right? And so have to see, even though they have very easy comparisons, they have an 11-point easier comp on their North America e-commerce business. So let's see where the numbers shake out. Also profitability will be very important.
I'll tell you what, I mean, AK, I look at this, you've got a decline of near 20%. Now, once again, we're going to go through it and get you the exact metrics that are leading to this decline. But if you were looking for something to stem the tide of the mega cap meltdown, this ain't it. At least not yet.
No, definitely not. And I think it's sort of predictable for Amazon. Right now, we're living in a moment of uncertainty. We don't know if the Fed is going to keep on with its push, although it seems like it is, but it might pivot. There are signs that some of the inflation is weakening, so maybe they, make a change. And in a moment of uncertainty, it's really difficult for a company like Amazon. Amazon's cloud business is entirely predicated on enterprise companies planning for a predictable future and saying, we're going to invest in our infrastructure. We expect to grow. We don't know that anymore. And it's a consumer business, the same thing. People saying, I have discretionary income and I'm going to buy goods. Without that predictability in the economy, which we do not have, it's really tough sledding for Amazon. And Microsoft, like Stephanie mentioned, showed us the way earlier the week. And now we're starting to see the results.
Let's get to Deirdre Bosa, who has the details of why this stock, D, is down some 19% after these earnings.
Let me point right to it. It is the guidance here. Q4 revenue guidance estimated at between, this is what the company says, guiding between $140 and $148 billion. The street was expecting $155 billion in Q4. This is the most important holiday quarter, so that is very light. Operating income, the street was expecting more than $5 billion. The company says to expect between $0 and $4 billion. So coming up short there as well when all the street is focused on cost. Amazon was supposed to have been working to getting this under control over the year, bringing in that extra capacity. In terms of the top and bottom line numbers, the top line is a slight miss here. $127.1 billion, $127.45 was expected. EPS 28 cents. I'm not going to compare that to the other number because there's a bit of funny stuff going on because of its Rivian investment, but it was, what I can tell you, is a $1.1 billion gain in Rivian. I'm going to continue to go through this, Scott, and I'll bring you numbers for advertising, for AWS, for all the rest of it.
Yeah, thank you so much. That's Dee Bosa. She'll be back on with us, as we said. Dan Ives, the revenue guidance is a massive miss.
That's a horror show relative to what you're expecting going to a holiday quarter. And I think it just shows the cautious that they're seeing, not just on the e-commerce side, but as Stephanie's talking about AWS, that's really been the Rock of Gibraltar for Amazon. And this is really what I believe is a seminal moment for Jazzy and Amazon to sort of get through. Otherwise, the bloom's coming off the roads really quick for big tech. And this is just another massive disappointment.
They did have 2 Prime days, right? I mean, which is a little bit unusual for the company. So they were seeing it hurt throughout the quarter in terms of demand.
I mean, Jazzy's, he's trying to cut costs.
Yeah.
Is it fair to say, Steph, you think that he inherited a bloated business?
Oh, no question about it.
And he is the one who is now charged with fixing it at a time where the former and founder, Jeff Bezos, is tweeting things in the last few weeks about batten down the hatches.
Stay-at-home beneficiaries.
Right.
They increased their distribution centers, increased their distribution centers, and now they're closing some of them. So they are definitely behind the 8 ball here. And again, as I mentioned, this is not a kind of market and an environment where you want to own something that is this expensive. And so I'm a little surprised that the reaction is a little aggressive because the stock's already down 33% year to date. But look, maybe it's going to catch up to Meta, unfortunately.
Maybe, Alex, not that dramatic of a stock slide given what we've seen. If you miss and miss badly, or if you guide, let's say this is a guide down, drawdown, this is the punishment that you're going to get in the kind of market that we are in. If we haven't witnessed that through the Microsofts and the Alphabets and then the Metas, you haven't been paying attention.
Yeah.
Absolutely, and it all comes down to the leadership you have. I mean, we see what's happening with Meta. That's a Mark Zuckerberg issue. So let's look at Amazon with Andy Jassy. Andy Jassy is fresh off a residence in Amazon Web Services, right, which has much higher margins than a retail business like Amazon Retail. And he's just not used to making the type of cuts that you would if you were in the more cutthroat division like retail. So Jeff Bezos, he grew up there, battened down the hatches. He knows how to do that. We made the leadership change. Does Andy Jassy know how to do that? Right now, he's proving that it's really difficult for him. And this is a big question. This is going to be the key question of his leadership.
Let's go back to Deirdre Bose, who has some more for us, D.
Yeah, Stephanie said a lot of the streets looking at AWS's cloud computing growth, and it actually dropped below 30% for the first time in at least 6 quarters. So it came in at 28% growth, which is still impressive from that enormous base, but that is a steeper than expected decline. And it actually came in about just less than $1 billion under expectations. I'll continue to look through this, Scott.
You got anything on advertising yet, D? Are we still going through that?
Let me see. Hold on. Okay, so that actually did come in a little bit over. So growth here is better than expected, 9.55 versus 9.5 expected. So we'll call that in line. But this was pretty much expected because the model is a lot more sturdy, let's say, than that of a Snap and Meta. This is intent-driven advertising. So, it is still a good thing that this came in line because of what we saw with Alphabet. So some strength there. But again, that AWS business is so much bigger that's what investors are really going to look at. $21 billion in the quarter for cloud versus less than $10 billion for advertising.
Yeah. Dee, thank you. I expect that we'll hear from you again momentarily. Steph, you were looking for 30% growth in AWS. This is the growth engine. The reason why some suggest you'll be willing to pay the multiple that those holders of the stock have been willing to pay. Yeah. Does this make you question that even further? If you've got a declining amount of growth, albeit slight, 28 versus 30, it's still not at street expectations. It underscores a slowing part of almost all of these businesses, right?
And I think you have a lot of generalists in this name to begin with, and they were thinking 30%. Anything with a 2 handle was going to make me very nervous. But I'm also looking, by the way, at North America. The North America sales came in below expectations as well. So you have both sides of the business coming in disappointing, and operating income is really quite disappointing. And then, of course, the guide as well. So,
yeah. We'll come back to that in a second. We didn't mention at the top, but Pinterest is out as well. Our Julia Borsten has that. Jules?
Well, Pinterest beating across the board, adjusted earnings of 11 cents per share versus estimates of 6 cents. Revenues coming in at 685 million versus estimates of 666 million. And the monthly and daily active user numbers are also stronger than expected. MAUs of 445 million versus 437 million estimated. And average revenue per user 3 cents better than anticipated at $1.56 per user. So we see that those better than expected results are driving the stock up 14.5%. A key thing here, since we've talked so much about the outlook for the fourth quarter, the company's saying they see fourth quarter revenues up mid-single digits, and the consensus is for up 4.5%. So slightly better than that. And they're seeing the operating expenses for the full year up 35%. So we're now watching Pinterest shares up. They were up as much as 16%, now up about 14%, Scott.
Yeah, Julia, thank you. Julia Borsten with Pinterest there. It proves, Alex, that not all social stocks are complete train wrecks. Right? I mean, after forgive us for thinking, after Snap and then Meta, expectations couldn't have been all that great for Pinterest, but maybe they're bucking that trend.
I mean, well, that's where all the Facebook revenue is going, apparently. But it is on a much smaller scale than these other companies. And Pinterest has been so down in the dumps for so long. Good for them for having a nice moment here. But, man, overall, we were seeing such a decline everywhere on social media. So Pinterest is your bright spot. You're in some real deep trouble.
We got intel out, too. Christina Partsenevelos has that for us. Christina, what do we see here?
So we're seeing an earnings beat at 59 cents a share. That's a 27 cent beat, I should say. Revenue came in at 15.3 billion, also a little bit higher, but it's the outlook that has been revised lower for Q4 and the full year. So we're seeing Q4 EPS guidance at 20 cents a share. The street was anticipating 66 cents a share. That's just for the next quarter. Revenue guidance coming in between a range of 14 to 15 $16 billion, also lighter. And then for the full year, the company said that they did have to reduce their full year revenue guidance between $63 and $64 billion to reflect continued macroeconomic headwinds. And remember, we heard about these looming layoffs. We still don't know details just yet, but in this report too that Intel sent me, they said that they are going to be focusing on driving $3 billion in cost reductions in 2023. So that's $3 billion in cost reductions. 2023, keep in mind that under Gelsinger, ever since he took over as CEO, headcount has increased about 16%. So maybe that's going to come down.
Yeah. Christina, thank you. We'll continue to watch it. Shares are up, despite a guide on both top and bottom that is well light of expectations. Jenny Harrington's on the phone with us now as well. She owns the stock. You guys may recall that. So, Jenny, you're getting a bit of a boost here despite this guide, which is disappointing. What's your initial read for a stock that's already down 50% year to date?
Well, I don't see it as disappointing because as we were talking about on the show today, it's just like you need it just not to be completely terrible, and how much pain is already priced in. And what we're seeing, Scott, is we're seeing the pain this earnings season, frankly, this year being delivered very asymmetrically. So Intel, they have had pain for the past, 3-5 years. And so now they reduced their guidance, but from $64 billion to $63 billion. That's just not that big a deal. This stock has been being treated as if it's going bankrupt, as if it's not going to cease to exist, as if they'll continue to donate market share to AMD for the rest of their lives. And that's not happening. And I think what we're reminded of today is that you cannot dismiss a company that produces $64 billion in revenues. Like, that's really significant. And they have an important role in our society. The other thing I think was an interesting juxtaposition between Facebook, who refused to cut costs and got hammered for it, and Intel, who's like, whoa, we're doing everything we can to be profitable, to be meaningful, and to improve our business. This is a professional management team that's operating and executing as well as they possibly can.
Yeah, maybe they kitchen sinked it, or the market believes that it has, along with the refrigerator, the dishwasher, and just about everything else. Jenny, thank you. Don't miss, by the way, Intel CEO Pat Gelsinger himself, 11 a.m. on Tech Check, so you get to hear directly from Mr. Gelsinger about the most recent quarter, and even more importantly, of course, is the outlook. Anything as a value investor, Steph, gets you interested? Because let's be honest, you have been interested in turnaround stories. You're in many. What about this one?
Yeah, no. I mean, and it is very cheap at 12.3 times, and it yields 5%, so that's attractive in itself. It is also down 47%. I just don't like the PC business. I don't want to be anywhere near the PC business, and that's probably why they're lowering the numbers as aggressively as they are. I do like the data center business. If I want data center, I'll go to Broadcom, which is just as cheap as Intel with a much better track record in terms of management.
I want to go back to the Amazon story for a second, just because the decline in shares is so significant, down 19%. You just don't see it all that often. Alex, I thought something really interesting in your notes today was when you said that business, Amazon, relies on certainty. I want to know, what do you mean by that? Because we are in the most uncertain environment that we've been in some time.
Exactly. It's a terrible moment for Amazon. If you're a business thinking about your infrastructure costs, thinking about your rate of growth even next year, we talk every day on this network about, is there going to be a recession or not? Are we in a recession? What sectors are in a recession? And those conversations are happening inside the boardrooms of companies that are deciding what their plan is for 2023. They don't know. And so when you have an uncertain moment, they're not going to outlay the big money they have been in past quarters on web services spending, because they simply cannot bake in that amount of growth. Now you're a consumer, you're deciding, how much money am I going to have next year? Is my money going to be worth what it is next year? And you're deciding, do I make that big purchase or not? And you're uncertain, so you're not buying. And that's really terrible for Amazon.
So we're less than 15 minutes away now, Dan, from Apple's results. I wanted to talk to you guys about Twitter, but frankly, it feels a little out of place given what's going on with the stock slide here. And Dan, what it makes you think about what Apple might have on tap in, as I said, about 14 minutes time.
Yeah, I mean, Scott, I think it's the biggest report, not just in tech, but across all of earnings, because, as Alex has hit on, it's really about what the demand picture looks like in China. The iPhone Pro mix, is that ultimately coming through? And this has really been, what I view as sort of Cook's been able to navigate any type of market. You look at services, could be a bit weak there. I still believe Apple we sit here a half hour from now, I believe they've been able to navigate the storm better than any other tech player. That's why, in my opinion, of the FANG names, this is the one to continue to own.
Even though you would suggest, as you've lightened up your position in Apple itself, that it's just not cheap in the kind of environment that we're in. And oh, what a difference it makes, because we used to say that exclusively about Apple. Oh, it's so cheap. X the cash. Look how cheap it is. Not anymore.
I know, and it's held up remarkably well relative of the FANGs, right? Only down 17%. But yeah, 24 times. It's just not compelling. It's not super expensive. It's just not super cheap, especially compared to other parts of technology. So I think iPhone is going to be fine. 52 million units, up 8% year over year. They have an extra week in the quarter, right? Supply chains get easier. So that's good. Services is going to be weak. The whisper number is 8%. Consensus is at about 10%. So let's just see. It's not a disaster. I don't expect a disaster, but is it going to live up to the expectations given that it's held up relatively well?
Still expecting record revenues, and we're going to get a good idea of where the iPhone is with consumers as well, a good read on China. Let's do this. Let's sneak a break in because we are just minutes away from those results from Apple. Our panel of experts is standing by as well to break down those numbers, everything you need to know about that. Do not go anywhere. The countdown clock is on. A little more than 12 minutes to go. We're right back.
Man, it all comes down to Apple now. Amazon doing what Amazon does best. Literally down about 19%, I think. Yeah, 19% trading at $90. Way below our fair value now. So let's just break this down very, very quickly. So Amazon's, what's really interesting is that I just freaking love how they say, oh, AWS didn't grow as fast as what analysts were expecting it to. It is a freaking $70 billion business, and it still grew at over 30%, 28%. I don't know who it was. I think it was what was that lady's name? I think it was Stephanie Link. She was like, "Oh, they didn't grow by 30%. They grew by 28%. That's such a miss." I'm like, "What are you talking about?" Like, in an environment where things are so freaking challenging, their cloud business grew 28%. Where is that growth rate? Right here. AWS, 27% growth year over year. My God, these people. But overall, $127 billion in revenue. I think it came in slightly better than what the expectations were. But of course, operating expenses eating into a lot of those margins. So operating income was $2.5 billion, and the guidance was slightly shy. I think they guided down to like 140 to as much as like 145 billion. Forgot what because right now this page is not loading up. Let's see if it loads up right now. But Apple's got so much pressure right now. There we go. This page started to load up here. Apple's got so much pressure at the moment because it is literally like that's gonna make or break the market, folks. Like that is it. Like if Apple doesn't support this market right now, because we've had Microsoft and Google down 9% after earnings, Meta down 25%, Amazon down 20%, and if Apple doesn't do anything here, it's gonna be one painful day tomorrow and Friday. It's gonna be one brutal rest of the week. So, all right, guidance here: net sales between 140 to 148 billion. So expected to grow between 2 and 8% compared to fourth quarter 21. So again, mid-single-digit growth here. And then in terms of the guidance, again, 155 billion. So really, I mean, we're talking for a company that's doing over $148 billion in revenue per quarter. This is the 3 months of revenue for Amazon. And, you know, because they're shy $6 billion, it's miss on guidance. I think operating income, obviously, this is a big driver for the stock after hours, expected between $0 and $4 billion compared to $3.5 billion in the fourth quarter of 21. So the guidance assumes, among other things, there's no additional business acquisitions, restructuring, or legal settlements are concluded. So, you know, the operating guide was a little bit of the concern there from Wall Street, but really the two things that ended up being a bigger problem was because of a revenue guidance miss, which is only $6 billion. And of course, AWS growth, which is coming in below expectations by 2%. So again, it all comes down to Apple here. Amazon, again, I'm going to dissect this report a little bit, and then we'll take a look. But if Apple, unfortunately, doesn't come in strong, we're already down, I think. Yeah, so we're almost down 2% after hours for Apple here. NASDAQ's already down over 1.8 now, so almost 2% for NASDAQ as well, and SPY's down over 1%. So what a great earnings season we've had. And this is only the beginning. Can you believe that? This is only the beginning, because if interest rates keep going higher, if interest rates get up to like 4.5%, closer to 5% by the end of this year, good luck. You wait till you get first quarter earnings here for 23. Wait till we get first quarter earnings. The Federal Reserve has to make decisions here. It's going to come down to the Fed. At November meeting, I think it's pretty much locked in 75. But starting December, it's going to come down to the Fed. It's literally, they're going to start seeing some pretty substantial moves in the economy with respect to unemployment, because unemployment doesn't move up, all of a sudden. It moves up slowly, steadily, kind of creeps up, and then boom, spikes all the way up to where it needs to be, given how high interest rates are going to be. And you're already seeing a lot of these guidance from companies. They're not expecting substantial numbers. Yeah, this bear market just got even more real for the NASDAQ. So if you take a look, I'm going to use Amazon's chart here, because Apple we're still waiting on. So QQQ selling off, of course. We're now almost back to those 52-week lows from October 13th. It would need to drop another 5% for QQQs to pretty much come down to those levels. And we can pretty much confidently put an end to this technical rally, because the NASDAQ obviously rallied a little bit over 12% from its lows. Very, very nice technical bounce. And this earnings season is pretty much bringing us back to reality. And here we go. Even without the red mic, we are done. So let's see. So Lauren says no November December rally. Yeah, it's gonna be tough. Really depends on what the Federal Reserve ends up doing, So, all right, let's see here.
Now,
sooner, I think a decent amount of people did, and I think starting at the end of last year, people really did. So that was an important move to make. Now, did we hope that they would be the ones that would still stand up in the face of pressure like they did the last?
All right, quick predictions here for Apple. We got 6 minutes left for Apple earnings to come out. Quick predictions, hit or miss.
We've been invested in them for a long time, and they haven't really led us astray. So I think there's probably a little bit of overconfidence on behalf of the investing public at large. But these aren't names that I think are going to disappear in this cycle. I think that they'll come back eventually. It's just that for this next 3 to 6 months, it's going to be really a tough slog for them.
Yeah, I appreciate it, Liz. Thank you so much. That's Liz Young of SoFi joining us. I'll talk to you again soon. I'm sure of that. Steph, I wanted to get your comment before we move to a different segment. I mean, this notion of staying too long, you saw the writing on the wall because you had removed or significantly reduced your exposure to tech over the last many months. What'd you see?
35% of the S&P 500 weighting in terms of comm services and technology overall. That's very, very high. And when I compare it to some of the more value parts of the market, like energy, for example, at just being at 5%, I just think tech was so overcrowded, and some of the value parts of the market, which I want to own when rates are going higher, are actually so much smaller. And so it was really just where did I think I could make more money, and where was there more opportunity? Where was I buying low, and where was I selling high? And really, I was much more worried about double and triple ordering in the space overall. And you've seen it.
Dan, I have someone on emails me suggesting this is 2000 to 2002 all over again. You want to push back on that, or?
I mean, I covered stocks. I covered stocks during those periods, and I view those as totally massively different periods because of the actual spending that's happening right now. I mean, we're going to have about $1 trillion of cloud spend over the next 4 or 5 years. These are companies that have cash to profitability, and I think this is ultimately a stark contrast to those years.
But we are seeing, we've already seen the meltdown in the highest of high valuation ones, and now it's starting to trickle through the tried and true, what some would say, defensive. We'll see what happens with Apple. We're less than 5 minutes away. Our all-star panel standing by with the instant reaction you need to those results. Don't go anywhere. There's the countdown. We're back right after this.
God, this is like so much pressure on Apple. Like, I'm feeling nervous. I wonder what Apple's feeling like, because the entire market pretty much depends on what Apple reports in 4 minutes. It's freaking crazy. No, so Marion, Apple has not reported yet. They come out in 4 minutes here. Oh, I don't think we've ever seen Apple come down that much though on earnings. I don't think it drops like other stocks do, because Apple's Apple. Like, Apple's been kind of like that staple stock. It doesn't get sold off as aggressively as what we're seeing for other companies, but this market has been like a meme market all of 2022. Even, crazy moves happening all across the board. Volatility is all out of range. So I wouldn't be surprised if Apple also makes a big move here. It would not surprise me one bit. It's unlikely because Apple has not usually done that. It hasn't really moved it's not one of those stocks that moves up like 8, 10, 12, 15% after hours like on earnings, but it wouldn't surprise me one bit if it does. So we'll see. So we got lots of people loading up on both puts and calls. Placing your bets. Should be any minute now. So less than 2 minutes away. Less than 3 minutes away, actually. So already down 2%. 140, 196 is where we are. For Apple, QQQ is still down. Down over 2% now. We got SPY down over 1.37. And the Dow Jones is down about 0.5%. So we're already expected to gap down pretty substantially tomorrow. Yeah, VIX, it's possible VIX opens up over 30, 35 levels tomorrow easily. Could be over 35 if Apple drops. If Apple drops like 6, 7% after hours, then easily VIX is over 35. If Apple rallies, then okay. We have at least one out of like freaking 10, 12 that pushes higher after hours. All right. Minute 30. Let's do this.
All right, we're less than 2 minutes away from Apple's results. The countdown is on. Our all-star panel is here. CNBC contributors, Stephanie Link of Hightower, Big Technologies, Alex Kantrowitz, star Wedbush analyst of tech is Dan Ives, and he is still with us too. Dan, the most important thing you were looking for in about 90 seconds is what?
It's iPhone units. It's really, is there upside there? That would indicate an ASP lift, more pro models, and ultimately the demise of Apple would really be false in terms of what the narrative was this quarter. It's about that services. You're expecting a slight miss, but it ultimately needs to be in that sort of 19.3, 19.5 area.
Services, the big area for you, Alex?
Absolutely. I mean, you've seen these moves that seem desperate from Apple, raising the rates for Apple Music, squeezing Facebook on the Boost post inside, apps. So what does that signal? To me, that signals that services are growing slowly.
See, instead of looking at me, I feel like you should be looking at Ives. With less than a minute to go, right? Because he's the uber bull, and you're questioning part of the bullish thesis. How do you respond to what he said?
And I think what Alex is talking about is really right now the big bull-bear debate in Apple, because services is a big part of the valuation. And if you start to see cracks and you don't see a reacceleration back to double-digit growth, that would definitely poke holes in the bull thesis. But I do believe, I respect Apple, in terms of everything they're doing on services, respect your opinion, but I just believe that Cook, again, will be Teflon-like as we come through.
We're looking at 8% growth for the services business. Again, these are behemoth businesses. One of the reasons why you're willing to pay what Stephanie Link says is a premium valuation is because of all of that. Yes, iPhone still accounts for half of revenues, but it's very much a services story too. Let's go to Steve Kovac now, who has those results. Apple earnings are out.
Hey there, Scott. They are
what a debt fake at the
beat here on the top and bottom lines, but some misses within individual segments. Let me break it down for you. Revenue coming in at $90.15 billion versus the $88.9 billion expected. That's a slight miss. That's a beat, rather. EPS also a beat, $1.29 versus $1.27 expected. Now for those misses within the individual segments. iPhone revenue coming in light, $42.63 billion versus the $43.21 billion expected. Still up 10% year on year. Services miss, by the way, is another miss, by the way. $19.19 billion versus $20.1 billion expected. Scott, I'll have more for you in a bit, but that's the numbers to chew on for right now. Looks like shares are down 4%.
Yeah, we'll chew on it too. Thank you, Steve. You come back on in just a moment. Ives, initial reaction, iPhone number light, services number light.
But better than feared. I mean, if you look at what the worries were, is that you were going to have potentially a $1-2 billion iPhone miss. Services, as Alex was talking about, that you're going to see a lot of softness. If you look at these numbers, just given what happened on the Plus, it shows that the Pro mix is probably about 80%. And I think as the street digests this, I think it's ultimately going to be a positive data point in a dark market.
You talk about the Pro being significant. It's a higher ASP for the Pro, right? And that matters, the average selling price, correct?
That ultimately was the hero this quarter because you're seeing more of that ASP come through, especially in China, despite what we saw with the Plus and some sort of choppiness in Europe. And I think that's ultimately what really stabilized the iPhone revenues this quarter.
But see, at some point, we can't look at a stock decline of some 5%, a miss on the critical iPhone, which again is half the revenue, a miss on services, say, well, it's just better than feared, and not address the fact that it still is a miss, and maybe the company is not going to be able to grow to the degree it was because of the uncertain environment that we find ourselves in.
And then it comes down to what's baked. It's a great point. What's baked into the stock here and what's the install base look like? I mean, right now you have about 25-30% of the install base has not upgraded their phone in roughly 4 years. They have that unique install base going into the holiday season. You have the China thesis. So I just believe relative to others in big tech, they will be a more formidable model that could ultimately penetrate that install base. And that's the key. And we got to hear what Cook says about the December quarter. That's going to be the key.
In fact, let's do it now because Steve Kovac had a conversation with Apple CEO Tim Cook. He joins us once again, Steve.
Yeah, I did. And in fact, I talked to Tim Cook about those demand issues Dan was just talking about between the 14 Pro and the regular 14. So here's what he told me about iPhone demand, specifically among the pros. He said, quote, "We're constrained right now on the 14 Pro and Pro Max and have been from day we launched. And so obviously we're chasing supply there and trying to get as much supply as we can to solve the demand." So as we've been hearing, Scott, for a while now, iPhone 14 Pro, they are just constrained on that, while the regular 14 is just fine. And to Dan's point earlier, that does help with the ASPs. Keep in mind, though, guys, this quarter is only 8 days of iPhone 14 sales, so we got a lot more coming through the holiday quarter. I also want to talk a little bit about how Apple was still able to beat on the top and bottom lines here, despite some of those misses within the segments. I asked Tim Cook about that as well, and how he's cutting costs. Here's what he told me, quote, "We are hiring deliberately, and so we've slowed the pace of hiring, and we're going after cuts and our savings into commodities." So slowing hiring, Scott, and savings into commodities, that means things like memory chips are getting cheaper for Apple as demand for smartphones and PCs goes down across the board.
All right, Steve, thank you. We'll get back to you in a moment as well. Hiring deliberately. Those are kind of words you want to hear, Dan Ives?
I think that's exactly what you want to hear. And that's why, as opposed to last night with Zuckerberg, Cook, that's the pilot you want on the plane to navigate you through this storm. And I think it shows they're gonna ultimately hire in strategic areas. Any sort of weakness, they'll ultimately, really be able to spot out. And this is what you want to see. You want to see margins that continue to really be resilient, as well as more and more that comes out of China. That's going to be key to the thesis. But I just want to say what he said about the supply constraint, right? That's important around Pro. They'll talk about in the conference call. That also is going to be something that the street's going to view as more demand over supply rather than supply over demand.
Yeah, and I mean, look, Kovac makes the appropriate point too, that rather than demand, it's supply. So the products still remain tremendously popular. Steph, constrained on supply is something we're going to just continue to hear about because supply chain issues. There's the China issue, which sort of is the overhang that's not really going away anytime soon.
I thought it would be better, to be honest with you, the supply chains, right? Because we know they're easing, and we're hearing that throughout earnings season from every company that it's getting a little bit better. So clearly, this is still an issue. So here's the problem. Services have over double the margin than products, and they just missed on services. And so you have to, I hope that they're going to do a good job at explaining why it was so weak. Probably App Store down 2% is kind of what we're modeling, but can it go from 8-9% growth back to double digits, back to Dan's point? Because that is really where you're going to get the juice and the operating leverage from the margin side.
Steve Kovac, I remember, since Steph just brought up the App Store and we're talking about the services miss, I remember when Katie Huberty, I think it was, of Morgan Stanley, raised that issue. Now, I don't even think she's covering that stock anymore. She's moved to a different job there. But nonetheless, there have been concerns about App Store for quite some time now, haven't there?
Yeah, there have. In fact, there's just been tons of data that app stores sales are going down. In fact, when I talked to Tim Cook and Luca Maestri just earlier, they were telling me it's gaming is falling, and this is all part of a recessionary headwinds that everyone's facing. Also, Scott, foreign exchange is a big headwind for them too. They were telling me in this when I was talking to them earlier, just how on a constant currency basis, they're really happy with what they're seeing on a demand basis. On a constant currency basis, these growth levels they were telling.
All right, so earnings calls are going to be starting up soon. I need to register and see if I can, get that going for Amazon and Apple. I just feel like the environment's really, really tough. And even with that, I think these companies are doing really, really well, at least in my opinion. Obviously, everyone's got an opinion. I'm happy to hear yours as well. But Apple beat on both revenue and earnings. Services, iPhone revenue was up, I think 10% year over year, but coming in light. Again, that's the thing, right? I mean, if you kind of just ignore what analysts are saying about the estimates and you just look at the business as a whole on an absolute basis, even if there's growth, that's good. I mean, Amazon grew revenues $127 billion on a year-over-year basis. I think that was, again, a growth of, I'm pretty sure it was double-digit growth because we're talking about the September quarter here. So if you go back and if you take a look at September last year, so this right here was the number, we're looking at about $110 billion, right? So 127 divided by 110, that's a 15% growth, right? 15% growth in an environment where really consumer spending is slowing down and interest rates are higher. So, the one thing that I like to look at is, what if I completely just remove what the consensus estimates were? What if we just remove the analyst estimates and just focus on the business and how did that do? These companies are doing still much, much better than what the environment is suggesting, right? Given how high rates are. So, bottom line is, obviously there's going to be a lot of potential headwinds, and this is only the beginning in my view. I think as rates go higher, things are going to start to slow down even more because the economy is just this really, really big sort of moving wheel where it takes time to kind of get this going. And of course, if rates keep going higher as they are supposed to, or as they are going to, as the Federal Reserve has already mentioned, another 75 in November, another 50, 75 in December. Well, we gotta really brace ourselves for what earnings might look like in Q4 and the first quarter of 23, which might not come out till April or May. So, that's where we are. I'm going to do a separate video again on all these companies. I just need some time. I'm going to break down all the earnings reports. I'll break down the intrinsic values. I'll break down some of the calculations, some of the key takeaways from all these companies, I promise. So we'll do that. As always, if you guys enjoyed this video, make sure that you drop a like and of course subscribe to the channel. Apple here is rebounding really nicely, although it's still down 1.5%, but right in the first 10 minutes, it was down over 5%. For context, I put that in the chat here. 5% on a $2.3 trillion market cap is roughly around $115 billion. That's like 3 Meta platforms and 4, I think, NVIDIAs and an entire AMD in 5 minutes, right? In 10 minutes for Apple. That's how much it was down. But thank you so much for joining. I really appreciate it. Make sure that you drop a like and of course subscribe to the channel if you're just joining us for the first time. Again, all the fundamental analysis videos will be posted over time here over the next few days on Amazon, on Apple, on Meta, Google, Microsoft. I've already done, but I'll do some more. Shopify as well as as the earnings starts to kind of roll in. So thank you so much. As always, happy investing. Have a great evening, great night, great morning, wherever you guys are watching from. And I'll post the market update shortly. Take care.